Okay, we are recording. So it is Wednesday the 9th, right in the middle of the week. Like I said before, we always like to start off with a song. This week has been, fairly challenging. It's difficult to find a couple of the names that are moving, especially the first 2 days of the week. We were essentially flat, kind of doji candles. And today, we started off the day in positive territory, and then just kind of sold off through the whole day, but not that much. S&P was just down slightly on the day, so I kind of think of it no harm, no foul. So the first 10 or 15 minutes, I usually like to go over a quick macro overview of some of the trends that I'm looking at, some of the observations that I've seen. I talk quite a bit about ETF inflows and outflows, so I'm going to talk about the trends that we've seen over the last month. A couple of them are pretty interesting. If you follow me on Twitter or if you're in the trading room every day, you probably know about them, but I'm going to go over them anyway. So let's go ahead and get into the presentation. The risk disclaimer, please go ahead and read this. It's a standard risk disclaimer. I'm no longer, I used to be a registered investment advisor, but I'm no longer right now, so I can't give any advice or recommendations or anything like that. I'm thinking about actually picking my licenses back up, but that's a whole nother story. So most of you are familiar with me. If you're not, quick background, we started the Tribeca trading room back in March, I think it was the beginning of April. So we're a few months old. Trading room has been going great, exactly how I want it to be. We've got great moderators, a great team environment, collaborative environment. Today was a good example of that. We found a couple nice plays to trade today. Nice names to trade today with several of you kind of putting a couple ideas in the chat box, and certainly I executed a couple of those trades today and made some money. So my style, very much macro. I'm a macro trader. Fits how I used to trade. I was a Delta One trader. So I used to trade a lot of futures, a lot of swaps, and then a senior ETF trader at Bank of America Merrill Lynch. So when you trade ETFs, they cover every nook and cranny of all the investments that are out there. So your domestic equities, your international, fixed income as well. So I'll also trade fixed income and very much look at trends that are going on with rates, especially with treasuries. And then I'll also trade commodities. We were talking about the VIX ETFs the other day. I used to trade those as well. When you're an ETF trader, you need to know how to price all of these particular areas. So you need to know how an ETF works, because you need to, when a hedge fund or a big investment fund comes in with a large block that they want to trade, you need to know how to hedge it, and you can't research it then. You need to have all of your pricing models and so forth. You need to know whether you need to trade futures, whether it's VIX futures to hedge a VIX ETF, or if it's a basket of international names to hedge an international ETF, or if it's a basket of bonds to hedge something like HYG or JNK. Same thing with domestic names as well. Someone comes in for a large block of, let's say, XHB or ITB. You need to know how to trade that underlying basket of equities. So before that, got my MBA from Rutgers University. I am from New Jersey. Started my career as a financial advisor at Morgan Stanley, Dean Witter. Twitter handle, you can follow me at CFromhertz. I put out a lot of information on Twitter just about particular things. I was talking about a couple different levels to watch in biotech today, and both of the major biotech ETFs, IBB and XBI. So I do try to put out as much information, not just about flow, whether or not somebody just bought or sold something, but whether or not there's the chart looks good in it, and kind of very similar to how we take trades in the room. We're not just following somebody because they put on a trade. We're actually looking to see if the trade makes sense. Okay, so the weekly review today is the 10th. We're right smack in the middle of the name. So August, have we seen anything surprising so far? We're almost in the middle of August. We're in the 10th. No, not really. Kind of a lot of what's normal for August. Low volume. we've been looking at SPY volume every day. It's about 20-30% less than the average 30-day volume. So, a lot of people take 2-week vacations in August. So that's some of what's going on right now. What you will see is a little bit more of whipsaw moves because the volume is so light. When somebody actually has a trade to do, whether or not they need to hedge a portfolio, whether or not they are putting on something, you're going to see the market kind of whip around a bit. We've seen that. There's been a couple examples of that today, a couple examples of that this week, where all of a sudden kind of nothing is going on, and all of a sudden you see a couple big red candles. Somebody's obviously doing a little bit of trading in the market. Is not picking up the volume very well. So you will see these moves when somebody actually has to do a decent sized trade. Not much has changed. I was actually just writing this webinar recap, from the last time we did a webinar, which was a couple weeks ago, and implied correlations, are extremely low right now. Let me go ahead and bring up the JCJ index. This is implied correlations of, so what is going on inside the S&P? Is it all moving together? Are some sectors outperforming others? Are some sectors underperforming others? So that's why you see this low correlation, out of the range. So, and it makes sense. Today, for example, XBI was down 3.1%, and the whole market was down, 20 basis points. And retail was actually up. It was the same thing yesterday too. We had a couple sectors that were underperforming a little bit more drastically than the outperformers, but yesterday semis outperformed, and XME metals and mining underperformed, as well as retail underperformed. So we're going to get those days, and that's what you that's what you can expect with low correlations. You're going to find that some groups are really outperforming and doing well, and other groups are being sold off for whatever reason. So you got these sector rotations that are also taking place right now. So just, what have we seen this week? When Friday we talked about, and we were actually looking on Friday towards the end of the day, we were looking for some sectors that we can, possibly fade a little bit, either sell call spreads or buy some puts. We found about 3 or 4 different areas that were a little bit overbought. I look at overbought based on the RSI, relative strength index. When sectors and major indices, not so much with single names, but when sectors and large indices, once they get greater than 70 RSI, they usually don't stay there for that long unless there's something unusual going on. Maybe something like, obviously energy names were oversold for a long time and stayed that way back last year. So that was a little bit different. But for the most part, things kind of bob and weave a bit. So semis got a little bit overbought. Biotech was one of those areas that got overbought on Friday. I think the RSI was the highest out of all these areas. The Qs were also above 70. So some of these areas, I call these kind of burning off overbought levels. I think that's going on right now in semis and Qs. Biotech a little bit more. So we're going to look at the biotech chart in a minute. But the last couple of days they've been selling off pretty hard, and you never want to buy, like, we're going to talk about obviously swing trades, but you never want to get into a swing trade when something is peaking out, is kind of getting overbought. So I still have my idea and have a couple different actually ways to play biotech, which I'm going to get into a little bit as it kind of does what it's doing and comes back in a little bit, maybe test a little bit of support. So the 10-year yields, we're still at 1.5%. We've kind of been staying, we're in the same place for the last couple of weeks, bouncing around quite a bit. I'll bring up a chart of TLT. Let me just rearrange this. You don't need to see market breadth now. The market's closed, just to make this a little bit simpler. We don't need to see volume that big either. So, TLT is something to really keep an eye on because it has so many implications. There's been just a mass move from the beginning of the year into higher yielding areas, utilities, telecom, REITs, consumer staples. They've really outperformed. And, if you saw my presentation a couple of weeks ago when I showed sector flows for the whole year in ETFs, there's just been monster inflows that have gone into utilities, that have gone into REITs, and to a lesser extent, consumer staples. So something to keep an eye on, two levels to watch: top of bottom, top of value on the daily chart, which is 141 and a quarter, bottom of value 130, 137. Right now we're kind of moving sideways, but if we start to, move out of this value area, something to keep an eye on because it affects so many different names. What else do we have going on? So, implications, there is no other alternative right now to stocks right now. So people can make that argument. You can argue either way for that. But while yields are really low, equities seem more attractive, especially with, I'm going to get to things to watch, but Fed fund futures. Even after that strong jobs report on Friday, it's actually come in from where it was on Friday. Fed fund futures are still not implying an interest rate hike anytime soon. September, it's 20%. November, the same. December is still less than 50%, even if you go out to February. So, this makes a great case for equities. If they're not going to raise rates, we're just getting through earnings season now, where the results have kind of been more of the same, where they've been decent earnings at best. There's been obviously best of breed names that are outperforming, that have beat earnings, and I think those are the names that you want to be in right now. We've also seen a number of names with high short interest that have rallied. You've seen like your names like Groupon. You've seen your names like what else? There's a handful of names that have had high short interest, that have beat lower expectations and have really rallied pretty hard. But it's basically I don't think there's nothing new that's come out of this earnings quarter than what we've seen the last couple years. So while there's no risk right now of an interest rate hike, at least till the end of the year, I think it's still a good place for equities. Doesn't mean we're going to get the occasional sell-off and the occasional correction, but I think you want to stand ready to buy in those places, considering that not much has changed with this earnings quarter, and there's no major risk of an interest rate hike, at least coming, not in November, certainly not in November either. One of the things that does concern me is global growth. I look at the Baltic Dry Index every couple of days. It's a good proxy for global growth. There is also a correlation to equities with the Baltic Dry. So something that doesn't sit right with me, and maybe a little bit of a negative, is that the Baltic Dry Index has been down almost every day the last 15 days. So you could look at this. It's BDIY is the index. You could see it's moved down a little bit. So it really advanced nicely in June, but it's basically given back all those gains in the Baltic Dry. So it's not at really depressed levels, but not the best thing when you see 4, 8, 13 days straight in July and into August that it's declined. Wow, it actually went up today. So it was actually up 1.1%. They only report this number once a day. But there's a trend changer. Looks like it rose 1% today. Commodities, got to continue to watch, as well as currencies. The U.S. dollar has been moving sideways. Couple days where it's really moved a lot this week. Oil, talked about this in the newsletter. I think the level that you want to watch is that bottom of value. If you go back to the weekly chart, you could see that we held last week. You only get one bar a week, but we had a nice hammer bar last week, but we're really not bouncing too much from that. And you could see other things are kind of giving sell signals, such as this crossover in the moving averages here. So it looks like we're resuming this downtrend for now. And sometimes these things flip around, but I think the level that you really want to watch, and I'll put this in the chat box, is 40.72 in oil. So this is the yearly value area. I think a couple people had questions about the value area study that I use every day. At the end of today's At the end of today's webinar, we'll, if you have any questions about the valuer study and how what it is, how it works, and so forth. But this is basically the price action for all of last year, and this is a really crucial support area. And we held it we went below and we held it last week. Nice hammer bar, but we want to make sure that we stay away from that level. So 40.72 is something to keep in mind for that level of support. That's the main thing. I'm not going to go into too much more, as looks like we've already gone 20 minutes. I usually like to spend 10 or 15 minutes, and I always go over a bit on that. So any questions so far? Any questions on things that we've covered? I do want to talk about the one bullet that I left out was, always like to kind of give you guys a trend or something that is a little bit unusual. And you don't hear too much about it other than me talking about it every day, is that, emerging markets are really outperforming. Of course, I have a trade on right now, so I'm kind of talking my own book a little bit. I am long EEM. I've been that way for about a month, but it continues to outperform, and I'll stay long until it either changes technically or they continue to add money. It's been probably one of the biggest areas that's seen inflows. This is $10 billion into EM ETFs, by the way, in the last month. So a pretty large number. And that's a good sign. So before I go into swing trading, just to kind of, like I said, I like to give you guys some information. This is what over the last month, overall equity ETFs have added 29 billion over the last month. Most of that has happened around in the weeks right after the Brexit. They've kind of tapered off the last week. They've been inflows have been really light. Friday was actually the biggest day of inflows for last week. I think it was about $2.5 billion that were added. Breaking this out in sectors, what's been going on here? Materials. I actually looked at the breakdown. I wanted to know if it was just straight the gold mining group. It's actually not. It's actually XLB and VAW. And also GDXJ has also added inflows as well. So it's not just the main material ETFs, but there has been gold mining ETFs that have actually added money, but it just hasn't been straight gold miners, which is in this material group. REITs continue to do the same thing. They've been adding money all year long, so another $1 billion into REITs. What's a little bit interesting, I think, in terms of this is for the first time we're seeing outflows in the utilities. Utilities, I don't have the numbers in front of me, but I think they've added about $4.5–5 billion in inflows year to date. So a little bit of money coming out there. Also, consumer staples is seeing some money come out of it over the last month. So, what I'm really looking for is a rotation. These areas have really gotten bid up, and there's been a huge amount of investment that's gone into REITs, utilities, and consumer staples. I want to see if, and I talked about this quite a great deal in the last webinar, that I really want to see if some of these defensive groups, if a rotation out of these groups and a rotation more into riskier healthcare, technology, financials, things like that, if that changes. What were the biggest ETFs, or what were the largest moves in ETFs over the last month? A lot of SPX, a lot of big index ETFs. There's three different major SPX funds, besides including SPY. There's also IVV and VOO. Why would somebody put money into these versus SPY? Because the management fee is lower. So when somebody's really looking to kind of buy and hold, they go into VOO and IVV rather than SPY because the management fee is less. People who trade probably just trade SPY. They don't care too much about the management fee because they're in and out. So emerging markets, EM right up there. That's a 1 month. So big change that represents a pretty big change in the size of fund. It's a 17% increase in the size of fund. Also EMB, which is emerging market bonds. These things have been on a tear, and a lot of money has been added to those as well. Another thing that you don't hear being talked about on CNBC is the amount of inflows that have been going into emerging bonds. And this isn't just 1 month. It's actually, well, this data is 1 month, but this trend has been going on for the last couple months now. And what's been coming out of the market? This has been the same trend all year long with European ETFs. VGK, another $1.4 billion. DBEF, $1.1 billion. This is labeled wrong. Sorry about that. This is Europe. Europe FX hedged, and EasyU. So all of these, contain a lot of Europe in them. So, I started to look at EWG yesterday when the DAX. Nobody was talking about this on CNBC either. I really don't understand. They were talking about Europe selling off this morning when it was down like 30 basis points, not even making any reference to the DAX being up 2.5% yesterday. I don't know what these guys are looking at on CNBC, but as Pat says, and MQ as well, CNBC is a TV show. But the fact that nobody was even talking about the DAX being up that much. So it's on my list of things to watch. But I want to see money start to be being added back into this and not just money going out. So that's one of the things, in my model that I use to do swing trading. I don't just look at one particular thing. I like to, have 2 or 3 things go the right way, or go the way that I want them to, for a swing trade. So that's my quick summary. Again, I always think this is going to take 10 or 15 minutes, but I did go longer than that. Any questions so far? And then we're going to get into the topic of the webinar, which I'm 20 minutes in. So apologies for going so long with that summary. Any questions so far? And then we'll get into the topic of the webinar. Nope. Okay. So, typically what we do in the trading room, and, every day we're looking for, oh, thank you. Thanks, Neil. What we're doing, every day in the trading room is we're looking for new trades, and, we don't get a chance to really talk about the structure of the trades. What size you should be taking on trades, what's the maturity that you should be looking at. Especially with unusual option activity, these things can move pretty quickly. When we're looking for active, we are looking to make money on, things that we can get into and out of the same day. But also, I do like to hold positions overnight. In a perfect world, of course, if I get into a trade that day and I'm following a big trade that happens, a big option trade that hits the tape, in a perfect world, if I can hit four targets and be out of the trade, so be it. But it really hasn't been happening that way. It's the trades that I, for the most part, have been doing are you hit 1 or 2 targets, possibly that day. Just like, for example, Lionsgate was a perfect example of that yesterday. We saw a repetitive buyer in Lionsgate right off the open, maybe a couple minutes. We saw a small trade, and then somebody continuing to buy Lionsgate. So that was a trade that I hit 2 profit targets in, and it's a December option. So we've got a couple months with that trade. Did I take it off at the end of the day? No, because I've got, Lionsgate had good earnings. It's got a couple things that I like about the stock. It had good earnings, and I like to see unusual option activity. It doesn't have to be that day after the day of, post earnings, but maybe a couple days later. But, it helps me define, so this is a December trade. It's a couple months out. So I want to think about, okay, well, I took some of that money off, and I feel comfortable. I've locked in some gains, but what do I want to do with the rest of it? Is it always, so this worked out nicely. This was a December position, but sometimes we see unusual option activity and it's front month. So the main point I want to stress is don't get over your skis on short dated options. If your average swing trade is, $10,000, you could use this for the same logic for anything. I'm talking percentages. Let's say it's $5,000, right? So front month or next month, what I've noticed with front month trades, and Pat talks about this all the time in the trading room. So what I want to do is I want to take normally a smaller position. I want to risk less money. Why do I want to do that? Because if the position doesn't go the right way for a front month trade, so what I want to get out here is you don't have to completely avoid front month trades, but I'm going to give you some alternatives if you don't want to trade, August or September trades. But if you do take them that day, keep this position size a little bit smaller. Are you comfortable with and the reason why is if the position doesn't go the right way right off the bat and the position starts to sell off, the position is going to go down quickly. You're going to lose that money fairly quickly if the position doesn't go in your direction right away. And it's very difficult in trading. Trading is very difficult in itself when you're in just a regular stock position to get it right off the bat the right way. But the odds are stacked against you if all you're trading is front month trades and you expect them to go right all the 100% of the time the right way. It's just not going to happen that way in trading, and which is fine. But if you're in a front month trade, you have very little chance to regain um, and turn that trade into a profit. So what I normally do, and this is, I can't give advice or recommendations, but what I normally do is take a smaller size trade for front month. And I'll usually put this in when I'm writing in the trading room, once I put, or once I send out the alert through my text alert, you'll often see me say 20%, 30% of position size. So that's one way to do it. So I have in here, do not swim against the tide. Swimming against, so what does that mean in option trading? Front month has the biggest decay in theta. So you're basically, if you get a really fast, aggressive move in the right direction, great, you're going to make money. There's no question. If it works out, wonderful. However, if it doesn't, even if the stock just stays where it is, you're swimming against the tide, because you have every day that you hold a position, the time decay is so great, is so large. So even if so you look at your position sometimes and you've got a trade on front month, and you look at the stock and the stock is flat on the day, but your position is down. There's no way to avoid this whatsoever for a front month position. It's going to lose if the stock stays exactly where it's at and doesn't move to this. Let's say you purchase a dollar strike out of the money option. If it doesn't move at all, it's just going to whittle away to nothing, and quickly, over those last 30 days. Pat says in the chat, I'm a promoter of longer term options, especially this time of year. Absolutely. So I wanted to talk about, if you're going to take that front month, again, I agree with Pat completely. If you have to do it, scale down your position size and have this set in your mind before you're going to trade. You never want to try to figure this out. Once you see a nice trade that hits the tape, you want to establish this all ahead of time. So once you see that, I talk about being golf ready. I've used the term in the trading room before, so if you've heard this before, I apologize. But I've used this term in trading, and I used to use this term in trading in institutional trading, especially because as a Delta One trader and as an ETF trader, there's a lot of steps that you need to do to hedge. And as I've taught people how to trade previously, you want to be what's known as golf ready. If you've ever played golf before, and you never, on a Saturday or Sunday, you never have the golf course to yourself. You're usually playing with a foursome, and there's people behind you, there's people in front of you. So when it's your turn to go up and swing the club, or to actually swing the club, you don't go up and take 5 practice shots. Oh, where's my ball? Where's the tee? No, you go up and you stand, you get up there and you have the tee ready to go. You put the ball on the tee. Maybe you take one practice swing and then you hit the ball. It's the same thing with trading. You figure out what you have that plan. You're golf ready, or you're trading ready before the trade comes. So you know exactly the position size. So if your position size is normally, your average size is 10,000, figure out what's comfortable for you. What are you comfortable with? If the trade goes against you, what trade side are you comfortable with? So there's my little golf analogy. Hope you like that, Pat. So other things that you can do. If you're in a front month trade and it starts to go against you, don't wait. Don't sit on it. Don't wait until it's not moving or wait till the position goes down. If you bought an option at 50 cents, don't wait till it goes down to 10 cents or 5 cents to say, oh, maybe I should roll the position. Maybe when you bought the position at 50 cents and then the thing is marking at 40 cents or 35, okay, maybe just take the trade off completely. Or if you still like the trade and you're going to need a little bit more time, go out a couple months. There's no harm in doing that. I've done that several times. I did that with, what was the last trade I did that with? Mattel. I was in a August position in Mattel. It didn't go the right way off the bat, was losing money. I said, you know what? I added to the position once, and then I said, you know what? I'm going to take this position off. I've got this big theta, the tide is going against me. So let me roll it out, give myself some more time. And I turned that trade into a profitable trade. Go ahead, Pat. Sure. So the right. So sorry for the I'm taping this on Google Hangouts, so you're not going to be able to hear Pat. So go ahead, Pat, if you have anything else to add to it. I just want to make sure because you're going to hear a pause in the recording. Okay, cool. Yeah, absolutely. And if every reason why you originally bought the position, I like to have basically two or three reasons when I'm going into an option trade, for the reasons that I'm buying it. If after a couple days that those things are still remain, but you need more time, sure, you could ratchet up that trade. You could pick a different strike. There's a whole bunch of different things that you could do to manage that trade. The other thing you could do is when you see front month options trade and you just don't want to deal with that position for an August position, a lot of times what I do, and the name has to be a liquid name for this. So slight disclaimer here is that it has to be a liquid name. If it's some name that you've kind of, a smaller cap name that you've really are not that familiar with, the name that people where the most open interest is going to be the most liquid option. So it may not work. This may not work for some of those names that really there's not a liquidity there, but in other names where the liquidity is there, but just in a different month, you could always, if there's a big trade that happens in August, it doesn't mean that you can't buy the September or October or November or even January position. If the name's going to go up, so are those other contracts in other months. It's going to work for you the same way. There'll be a little bit different, more of a pop in the front month trade. You are using less money for the front month trade because you have less time, obviously. So it's a give and take there. But if the stock's going to go up, so are those other those longer dated positions. So that's basically how I look to do front month. I don't completely avoid front month, but I'm disciplined about it. I'll very rarely take a full size, my full size trade on a front month trade. It's just too risky, especially if you're going to hold a position overnight. If you don't hold positions overnight, that maybe you can change this up, or maybe it doesn't exactly apply to you. But if you're going to hold positions overnight, which I like to do, especially once I've hit a couple profit targets, there's other things that you can do. So any questions so far on the front month or next month trades and position sizing? All right, moving right along. And please ask questions if you have, if something is not clear. I do go through things rather quickly. So if you have any questions at all, let me know. So 3 months expiration. So kind of, in the middle of a long-term trade and, and a short-term trade. So I usually do 50 to 70% position size, and I plan on scaling. A lot of the times I'll say in the trading room, hey, I'm starting a position. So maybe I'll go into the first clip 20%. And the reason why I'm doing that right now with an IYZ trade with a telecom short. This gives you more. The further you go out in time, gives you more flexibility. I like to kind of leg into positions. Unless I find something that's perfect time frame. We see somebody who's going in with 2 feet in. We see a huge option activity trade. Okay, maybe I'll take a little bit bigger of a position off the bat. But if it's something that I'm looking at as a swing trade, I want to have the ability also, if the trade goes against me a little bit, I want a dollar cost average down. So you don't always pick the perfect time to get into a trade. So you want to leave dry powder always. Sometimes I'll add to a position maybe up to 3 times or no, total. Once will be the first time I get in 20%, then another 20%, then another 20. And now I've grown to my size of 5,000 to 7,000. So what I've learned also, I've been trading options for a long time. I've been, traded institutional money for a long time. Being erring on the side of being conservative and having this type of plan, it really helps. When I've lost money in the past, everybody loses money as a trader. If you haven't lost money as a trader in the past, you're flat out lying. It happens to everybody. There's going to be times when you have bad weeks. It's just part of, long-term trading. You're gonna have times when, a couple trades go the wrong way. It's just, and if you're not used to that, um, it is what it is. Maybe trading is not for you if you can't handle a couple trades that go, the wrong way. Um, you know, then trading may not be the right career for you. But it's for a long-term trader, it's just how it is. Not every trade is going to work the right way. But if you have this plan where you're not going in huge size in the beginning, there's things that you can do to kind of fix the trade, such as rolling out or adding to a position when it's down, so that it's not the end of the world that you take a trade and the name goes down, or the your investment goes down. So you don't have to go all in the beginning of a trade. Okay, so for a longer data trade, so we're in what, August, so plus 5 months, so September, October, November, December, so basically January or further. I can't believe we're almost going to be, January is 5 months away. So I actually am starting to look further out than January for some trades. You have just a lot more flexibility the longer you go out. You can also do the same thing. So the same thing applies for the 3-month trades. You can scale in, you can add on dips. You could also do a lot of other things, like you can sell front month against this. I do this quite a bit. I turn some trades into calendars where I've got a longer data position. I did this with White Wave for about 3 months, where I started a January position. I think we saw a big call position in January in White Wave. And it was a lot of premium for White Wave. It's a high. You could do this with a name that has a lot of volatility to it. So, something where, I think White Wave, I got into options in January. I think they were about $3 or $4, 350, something like that. And what I did was, and I don't do this one for one. I don't want to kill all my profits if the name goes up, or if it got taken out, which White Wave did. But I want to do this for maybe 30% of my trade. This way, I'm recovering some of my premium. If I'm bullish long term, White Wave, which is what I did. I think back in March, I sold April front month against the position. That worked out beautifully. Then at the end of, once April expiration came up, I sold June calls against it. The only time it didn't work is after June. I rolled this, I believe it was 2 or 3 times on a calendar spread, and I rolled it again into July, again for about 30 to 40% of my net long position, and that's when White Wave was announced that it was being taken out. So I lost a little bit money on the short front month calls, but obviously the 70% that I was long was a huge win, and I made all of that money on the previous front month calls that I had sold back in April, May, and June. So you have that ability to do that. So you could go full size. And again, I don't go full size, right away, on a trade, unless everything is kind of setting up the right way. But I always want to have that dry powder to add to a position in case my timing isn't right. And, many times my timing isn't perfect. So I do that quite often. Okay, so that's the first part of position sizing in option trading. Any questions so far? Those are kind of the three things that I look at. Again, I have all of this kind of laid out ahead of time, so I'm not struggling once I see a nice trade. Yeah, I don't know. Yeah, so I'm just reading your comments, Mark. I don't know why you have Central Time. I never do anything by Central Time. We're in New York, Eastern, baby. Financial center of the world. Never Central. Sorry for your mix-up. Okay, so I don't see any questions. So how many positions? So we get into another area which I wanted to cover. I generally will trade a portfolio of options for swing trades. How many positions are optimal? So this kind of differs based on personal preference and what you can handle as a trader. I've been trading. Can I show examples of recent trades? Yeah, you could actually. So full disclosure, if you look in the notes of right below the chat boxes, the notes, you could see all the trades that I'm actually in and all the targets. So there's all examples. I'll walk through a couple of these trades. So any one of these trades, I've got Cisco on long term. Applied Materials is a little bit shorter term. ECA, and we've actually been seeing a lot of nice longer data positions in option activity that I've agreed with pretty well. EM is my biggest position right now. That one is hugely in the money right now. Microsoft, we've been seeing a lot of Microsoft calls go up. But anyway, so I'll go over any one of those positions that you want to go through. But, I put all my positions, when you come into this webinar and how the Tribeca Trade Group trading room works is, there's full transparency. You could see at any time, you could talk to one another. Other trading rooms, you'll find that people, those companies, like they kind of hide how many people are in the room, or they don't let people talk to one another. This is completely a collaborative trading room where we're all trying to work together and make money together. So, I want people to collaborate and talk to each other. A lot of people use GoToWebinar. This is the exact trading room that we use, and I want people to see the positions and so forth of what we're trading and so forth. So all those examples are in the notes tab for you. Okay, so let me keep on moving. How many positions are optimal? Going back to the don't get over your skis on short-dated options. Don't get over your skis as well with taking a lot of positions. I find that every once in a while, I'll get over my skis and have too many positions on, and I'll have over 20 positions on, and immediately, I'll review at the end of the week how many positions I have on, and if I get to that point, I've got too many positions on. It's too many for me to manage. And what'll happen is you'll end up looking at those positions and you start missing new opportunities. And especially when one of those positions goes against you for whatever reason, you start looking and obsessing over one position. So if you have about 5 to 12 positions on, and you can see that's basically what I have on now, right in the middle of that, I think, for most of my swing trade positions, it's just too much to manage once you get to those around 20 or above positions. And it's also not the right type of market to have a lot of positions in. If we're in a big trending, where we're moving up every day at a nice clip, great. Sometimes I'll adapt to the market. So if we're in some nice, where we're really moving to the upside very nicely, I can have more than maybe 10, 12 positions going on because we're in a nice trending market. Right now, we're in a choppy market. So, as I mentioned before, you've got some groups that are performing really well and some others that are not, and that switches around. So if you've got a ton of positions on, you get bogged down in these moves. And the major thing is, when you're looking at your positions all day long, you may miss the next nice trade. When you start to neglect other positions as well, so you may miss on those new opportunities because you're fixated on your existing positions. Option positions are a little bit different than equity positions. I think I have some place in here. Options are stocks on steroids. So with a stock portfolio, like in your IRA, you can kind of sit with a long-term portfolio and manage it a little bit better, but you can't put option positions on autopilot. You can't just have them. A lot of the times they need to be managed. So having a smaller set of positions for me, really helps me a lot. And also, every couple of days, counting how many of those positions that you go through. I also like to cycle through positions. As I'm adding a couple new positions, I'll like to say, okay, not every position that I have on the books may be a position that I really want to hold on to. So a lot of the times I'll unwind positions. I don't use a lot of. Sure, absolutely. I'm going to go through an example. I'm just reading your question. I also see a couple other questions. So let me pause here and go through your questions. Do you have a trading account and then investment account and retirement accounts? Is your sizing based upon your trading account? What percentage of your overall portfolio represents your trading account? So, right now, my general trading account. So basically when I'm talking about all of this is just for my trading account, which is, I usually trade with about $100,000. My other accounts, I do have a larger IRA account. Those positions for me are buy and hold. And I normally don't trade options in my IRA and those type of retirement accounts. Those are just straight stock. Can you show the process of decision making to arrive at taking a position? Okay, so I'm going to get to that one, Ali, in 2 seconds. Let me just go through the last couple of bullets that I've got here. Option positions cannot be set to autopilot. They need to be managed. So I often cycle through positions. I also set if I have a profitable position, like I did this in EPD today, I hit 2 targets in EPD. It went back to my cost basis. So sometimes once I have that profitable position, I'll use my cost basis as my stop price. And I'll usually get out of positions once they stop working in my direction for me. So that's another technique that I use. I also go through and review positions, usually at least once every couple of days, and I'll go through and I'll say, I'll look at the chart and I'll kind of remind myself if normally I like to get into a position for 2 or 3 reasons, and if one of those reasons is no longer there, why do I have the why do I have the position on? Is it just because I use the phrase because some Yahoo bought, all day long we're looking at big option prints, but that's not going to be my only criteria for getting into a position. Just because some other, hedge fund bought a position, hedge funds have been getting smoked this year, as well as last year. So I need to have more insight into why I'm getting a position. It's got to be more than one reason. So let me go through the question, because that's pretty much the end of the presentation. I'm going to talk about my new swing trading program. I'm going to show you the process of, so I talked about EEM in the beginning of my process, at the beginning of the webinar. EEM's been up 3% this week. It keeps chugging along. It's outperforming. It keeps having ETF inflows and outflows. ETF inflows, just huge amount of ETF inflows. So the other thing why I established a longer term swing trade is because it's set up very nicely technically. So this was my second reason. So what alerted me to emerging markets in the first place? It really wasn't unusual option activity. It was ETF inflows. I started to see, I track this every day in a spreadsheet. If you follow me on Twitter, I put out every day what the biggest inflows and outflows were. I do this by sectors. I've got a spreadsheet of 1,500 names. I group this by country. I group this by sector. I group this by style, whether it's emerging markets, whether it's high yield bonds. It allows me to make a lot of generalizations about where money is going into, because that's basically what we're watching with option activity, right? It's where people are putting their money, where big institutions are putting their money. So I'm doing the same thing using ETF fund flows. So what did we see in emerging markets? This is a trade that I've been kind of stalking for a while, and sometimes I do this. I've got watch lists where I've got names on here. But the first thing that I saw is, a big buy signal in emerging markets using my own indicator, and a move inside to value. This is the weekly chart. This is the value area. This is where previously all the volume at price was centered around inside this value area. And academics who use technical analysis, analysts who use value area studies is sometimes, for the value area, once you're firmly into the value area, there's what's called an 80% rule. meaning once you've established inside the value area, there's an 80% chance that you can go from the bottom of value all the way to the top. Now, this doesn't happen immediately. Sometimes it could take a long time. Hence why I went out to, I own January and June calls in emerging markets that have been working really nice. And I've actually calendarized that a little bit. I've sold a little bit of front month, which is not working. The front month calendar has not worked. But I only do that, like I said, for about 20 or 30% of the position. So that's a lot of my criteria of why I go into a position. We've actually been seeing a little bit of call buying in EEM. So let me just make sure I answered your question. That's some of the decision processing that I'm looking to arrive at taking a position. So it goes back to why I look at option activity and call it unusual option activity, whatever you want. Why am I looking to do that? I'm looking for ideas half the time. That is what I did on SWC, for example. I was hoping for a little bit better of a pop today in SWC. Stillwater Mining, for example, a name that I've never heard of. And about 2 weeks ago, we saw January calls being bought. And I looked at the name. I said, well, what is SWC? It's a miner that refines platinum and palladium. And then I said, wow, I believe platinum and palladium have been doing really well over the last month. You could see the move today in platinum's actually gave back a lot of those gains from today, but palladium also gave back the gains, but still ended up, I think, about 5%. And if you look at a chart in palladium, something's going on here. These two metals, platinum and palladium, have been on big runs. So, that's some of my decision making. So sometimes I don't go into the position right away. I do a little bit of research. And I'm always looking for new ideas. So sometimes we see option activity and a name I've never heard of. And then I go and do my homework. Pat does the same thing. MQ does the same thing. If you follow Pat, put your Twitter handle. And same thing, MQ. Put your Twitter handles in here. If you follow Pat on Twitter, every night he's looking at names that saw unusual option activity, and he's looking at the chart for possibly a longer term swing trade. All right, so I hope that helps. I hope that answers your question, Ali. That was a long-winded answer, but I've got a lot of things going on. Usually, like I said, at least two reasons. I like to have 3 reasons why I'm getting into a swing trade. Okay, so that's pretty much the end of the presentation. I'm going to talk about I'm going to talk about a new program that I'm doing. It's kind of a new but oldie. So I'm restarting. I've decided. I made a decision. Somebody asked me on Twitter the other day because they were looking at my performance of earnings trades this quarter. My performance of earnings trades this quarter is right around return on investment of about 42% over this quarter. And they said, that's great. Do you have they said, but I'm a swing trader. Do you have your performance for swing trades? And, I said, no, I don't. Let me just see if there's an email on this. Okay. So, somebody asked me, what's your performance of swing trades? And your option house or your thinkorswim doesn't break it out like that for you. And I thought to myself, I don't have my performance for swing trades. I couldn't tell you what they are. I've been keeping all of my performance logged in a spreadsheet. Let's see, where's my spreadsheet? There we go. So I've been logging, keeping track because I want to know 2 things. if someone is following me trading earnings, and thinks that, I've got my own model for trading earnings, and right now it's up 42%. And every once in a while I hear people say, well, earnings trades don't work. And I like to say, well, yes, they do. They do work, because I've got 31 trades going on, 32 trades going on, and 18 of them have been winners. My winning percentage is 58%. To have metrics, to tell somebody, and also if it doesn't work, if my return on investment was negative, I don't want to do the trade anymore, right? The model that I have doesn't work. So it's one for me to keep track and know. I want to know, hey, am I just doing, trades just to do for the hell of them? Just to do a trade, just to say I did a trade in a name? Or am I doing trades to make money? I'm doing trades to make money, and I want to quantify that. And I honestly want to prove it to people too. I want to say, hey, earnings trades do work if you have the right model, if you have the right system. So I did the same thing for this. I had the same type of spreadsheet for swing trades back last year, and I ran a program that went from basically, I think we started it in around June of 2015 till January. And it had, similar return on investment, 51% return on investment, 73% winning percentage, 24 wins, 9 losses, just in about 6 months. And, so same thing. So how this this program, swing trading program that I'm restarting, it's basically going to be mostly ETFs. It's going to be 75% ETFs, but I don't want to handcuff myself, because I do trade a lot of single name equities. If there's going to be more, so Rick, I'm going to answer that question in 2 seconds. So I don't want to handcuff myself to just ETFs, because I do trade a lot of equities, and sometimes there's better opportunities in stocks. So this is probably going to be the benchmark, but this can change a little bit. But for the most part, I'm going to look at ETFs. I'm going to look at maturity of probably at least 2 months for most of my swing trades. They're going to be directional plays. They're going to be selling premium calendars. So Rick just asked, they're also going to be LRR. Anybody know what LRR means? See if anybody knows what this one is from Webb's days. Hint, hint. Limited risk reversal. Yep, I'm going to be doing those trades as well, where I basically buy calls and I sell a put spread, or vice versa. So Rick, I want to ask your question. For your earning trades, is the best strategy credit spreads or debit spreads? My experiment says credit spreads. It all depends on the setup. This quarter, I would say definitely credit spreads have been working for me better. I've had much better wins. I'll go through my list for you. I've got a lot of names that, I had some directional plays, debit spreads that worked in the beginning. Biogen worked pretty well on the call side. I've done iron condors on a couple names. I did iron condor on Chipotle. I've done directional plays. So it's a combination of names. But, I've had names that have worked selling an iron condor in Amazon. I sold an iron condor in Tableau software. I sold a put spread in Tesla. So it's been a combination of names that have worked for me. So I always like to do both. It really depends on the setup for earnings trades. It also depends on the setup for swing trades as well. So I do, selling premium. I do that a lot in the VIX ETFs, which are, in my opinion, one of the worst products ever invented. VXX, VXY, great to always sell premium when these things spike. It's one of my favorite swing trades to do. Obviously, we're not in that time frame right now as the VIX is low. No, I don't do that nonsense of, I see Mark putting in there 20 spots only. That is complete nonsense. If you ever hear anybody say that, where they only have 20 spots left, that is complete bullshit at a particular price, at a particular price level. So you'll never hear that from me. So I am offering the program that I'm doing. And if you're a member of the room, I'm not charging anything extra for this. You can participate in this program by just being a member of the room. But for those who want to check this program out and you've not done it before, so basically how this will work is Basically how this will work is you'll get text alerts for every trade I do. You also get a video. I don't think I have that in here. You'll get a video of the rationale for why I'm going into a trade. So, the day when I put on a trade, and sometimes what I've noticed from the previous program that I've done is that sometimes I hit target same day. It really depends. It really depends on my timing with doing trades. So sometimes I hit targets that day. The average hold time for these trades could be a couple days to a couple weeks. That's usually how I ran that previous program. But so even if I hit a couple targets that day, what I'll do usually that night is I will send out a video basically explaining the rationale, which is good for me too, because if I can't come up with if I can't make a 5 or 10 minute video of why I went into a trade, it's not worth taking the trade in the first place. Usually how I trade is about 3 to 4 targets. So for example, if I get into an option trade for $1, I usually try to stick to 15% targets. So $1.15, $1.30, $1.45. And it will depend on the trade. If I really like the trade, sometimes I'll widen it out a little bit. Or if it's a longer dated trade, like my EM trade right now, swing trade, like I'm using about 25% targets right now. So I change it up depending on what my comfort level is in the trade. And also the length of the trade. I'm out to January and June in emerging markets. So this program is going to be $69 a month. And the discount that I have for you with that coupon code is for the first month, because I want you to check this out, $35 a month. So, I think it's worthwhile checking out for $35 a month. Come on. So a lot of these offers, I basically give them away for the first, so that you could try it. And the reason is I'm pretty confident that you're going to stay. So I don't mind giving away like a free month. I've had a couple of people tell me, hey, you give away too much. We started that when the Tribeca Trade Room, like I was giving away like the first month for free when we first started the trading room. And I was like, well, I think people are going to like it. I think people, if it's going to make you money, you're going to stay. So, I think with this type of program, the return on investment of 51% of what we previously ran, that performance speaks for itself. So I don't have a reason why you would not try this for $35 a month. What you can expect for the first month, I usually do 1 to 2 trades a week. I'll be honest, sometimes if there's no opportunities, I'm not going to just trade to do a trade for a swing trade. So if the environment is not right, I don't trade. I have seen weeks where I've actually done 2 or 3 trades though, if the environment works, where I'm seeing a lot of opportunities. And you could see, basically I did this for 6 months, and I had 33 trades. So if you take 33 trades divided by 26 weeks, it averages a little bit more than a trade a week. Cool, Jim. Thanks for participating. Thanks for coming to the webinar. Appreciate it. So there you go. So if you go to the webinar, not the webinar, if you go to the website, I actually have a link for this, but I lost it. That's why I was struggling a bit. So what you want is the option swing trading program. So let me go ahead and put the link. I do have a link here someplace. Just bear with me a minute. I am not the best webinar organizer. Let me just make sure that this works. There we go. Here's the link. And the coupon code is right here. Make sure you use that. It's basic 50 off. That is a 0 in there. So I see most of you are members in the room. So obviously you don't have to do this. It's going to come included with your membership. Again, I don't try to penny and dime you guys. Yes, the newsletter is also included in this program. which I don't even have in here. So you also get my newsletter that I spend a huge amount of time trading. So, the $69 a month is well worth the, I'll give you the example. We've had some awesome calls in last week's newsletter. I mean, basically every newsletter. I hate to tell you, but we make some really good calls basically every week. So it's not just a newsletter that talks about like the week's events. It gives you some actionable ideas and levels to watch for you to get involved in names. Yeah. So the newsletter comes absolutely included. So what did I talk about last week? Just talked about the S&P, talked about best performing sectors, what we're kind of seeing. I give a comprehensive, just as I talk about and study every day fund flows, I tell you what's going on. I've been talking about the emerging market inflows every week. So I talk about trends that I'm seeing. And, I talked about crude, talked about emerging markets. I'm also looking at a long swing trade idea right now in FXI and EWY, which is South Korea. Talked a little bit about XLF, which I'm not ready to take a long swing trade in right now. I want to see actually people buying, which I don't see a lot of inflows right now. So technically, it's starting to look okay. XLF. Keep in mind, XLF again is not banks; it's only 40% banks. I'm always very adamant about correcting people when they say XLF and they say banks. XLF is not a banking ETF. It's not even doesn't even have a majority of the ETF in banks. But in any event, it's starting to look technically positive. I think it's actually cooled off. It actually gave back some of those gains from Friday when financials were up a really decent clip. So I'd rather wait. I don't want to be the first one in a trade. I'd rather wait. So you can see it's actually come back the last couple of days. But I want to see a lot of money start to being put to work in different financial companies and banks and so forth. It doesn't have to be XLF exactly. Could be individual names. Could also be fund flows. And then we had stocks to watch. We had Microsoft. We had AIG, which was a really nice profitable trade for me in the trading room. SLCA, which I don't have a trade on now, but I'm kind of watching. It's got a lot of upside VPOCs that could possibly be hit. So that's an example. So you do get the newsletter include as well. Yeah, I actually saw two-way flow in KRE today. So go ahead and so I will tell you this. I won't go through that nonsense of how many spots available. I'm only going to be offering this probably tonight. That's it. I'm not going to offer this special of $35 for the first month. It's just $69 is cheap enough to get this program for something that previously made a lot of money and also includes that newsletter, which I think I should just be selling the newsletter on its own for $69 a month. So there you go. Let me know if there's any questions. We've went just a little bit over an hour. So if there's any other subjects that you guys want to talk about or cover in tonight's webinar, I had a question or two earlier in the week about other things that we don't get a chance to go over, like value areas and so forth. But so happy to go over any of those. Yeah, and Pat's also contributes to that newsletter. He's got his stocks to watch as well, which he does quite a bit of research on those names and have really set up nice. And Pat has called out a number of names that he's had on his newsletter before we actually see that unusual option activity, or a number of names that have gotten bought out as well. A huge amount of names that have gotten bought out. So any other topics that you guys want to cover? Any questions? If not, I usually go about an hour and a half for these webinars, or any other stocks that you guys want to look at. I mentioned I was going to take a look at biotech. A couple of things I realized. WDC, sure. So Western Digital, I always like to start with a longer term chart first. and then look at the bigger trend and then go in closer. So take a look at so this is exactly why I use value areas. First of all, the stock's been in a big downtrend for the last 2 years, essentially. But since the beginning of the year, it did bottom in this downtrend. It did kind of change trend a little bit here. It almost got up to the top, to the bottom of value, but you could kind of see it got close enough and rejected it. So on the longer term trend, I think it still looks pretty bearish. So you had time to make money here in this move up, but it never really got into firmly, actually not even firmly, it never got into the value area. So, and it's been turning down here on the weekly chart. Let's take a look on the daily chart. Same thing, I've been using these VPOCs, have worked really well. This is the new, this is the TTG value area study. So a little bit new. It's got the VPOCs, which I've been using for targets. So I would say for the downside swing, I would say I'm bearish this name, and I would say $38 to the downside is where you want to be taking profits on a short. Name was down 4.6% today. I don't know what if there was news on this name, but you got a little bit of support here. If it continues lower, I'd say this is setting up for a nice short, or remain short. Here was your sell signal back here on this big candle. What was this? Was that earnings? Yeah, that was earnings. Interesting that day. I remember Western Digital, when they reported earnings, the initial reaction was higher, and they reported after the close, and then gave it all back and then some. So huge sell-off in that name. And I don't know if that came about in the conference call or what have you, but to me, the chart looks pretty negative. I said I was going to talk about IBB. So it did get overbought. I mentioned IBB got overbought on Friday. I think biotech is going to be, I don't know if we're going to see much of a trend in biotech. It tends to be very choppy. We did have a nice move. We've had this move a couple times where we moved up, gave it all back, went up, gave it all back. We've got a little bit more progress of a move here, where we came out of this range finally in IBB. So we did get overbought. So we're coming, as long as we stay in this positive trend. I don't know if I'm going to put on a long call play. Maybe I'll sell premium. The premium is still pretty high in a put spread. We saw a nice trade a couple weeks ago where someone sold September put spreads. So if we kind of stop the decline right here, and I'm actually watching something on the hourly, I think we could, in the short term, I think we can get down to 284 in IBB. So maybe one more day of declines. And if we hit this, then I might be looking to sell premium on the short side. And I'll wait for a turnaround before I see that, some type of a signal. And there's patch stocks to watch for tomorrow. So any other questions? If not, we'll cut it off a little bit early. Like I said, I normally go about an hour and a half, but it's about that. Maybe 10 minutes short of that. All right, great. Well, so if you're not a member, if I see obviously a lot of you are members, and thank you for coming to the webinar tonight. You don't have to sign up for this program. You get it included with your membership. Something that I want to give to you guys as a service. If you're not, or if you can't be in the trading room every day, then this is an ideal program for you. So you guys have a great evening, and we'll cut it off there for the night. Have a great evening.